Hey, good morning, traders and investors, and welcome back to our weekly live stream show. I'm your host, Bennett Tyndall, tradinganalysis.com. We appreciate you all taking time out of your Tuesday mornings to join us. Happy May 3rd. My goodness, this year has gone by way too quickly. We typically host this show every Wednesday morning, but we've had a little bit of a change up this week. We decided to move it to Tuesday. I will be out this afternoon. If you guys were tuning in last week, we did not have a weekly show last Wednesday. I've been dealing with a bit of a dental issue, but we're going to get that taken care of, and we most certainly couldn't go 2 weeks without meeting with you guys. So we've got a good show planned for you this morning. It's going to be a little bit shorter than normal. Market volatility continues. Indexes are trading broke south of February and March area support. We knew going into April that April would really be the month that established the opportunity zone and established sentiment for the remainder of Q2, if not Q3. And going into April, we were expecting markets to either confirm the idea that the wave 4 was over with upside continuation, or alternatively fall victim to the alternate wave counts. We have the highly anticipated May Fed meeting coming tomorrow, again, 2 p.m. Press conference 2 p.m. announcement, 2:30 press conference as always. Markets are currently pricing in a 50 basis point move. Interestingly enough, if you look at the structure and the indexes, and we're going to get to the charts in just a minute, but although there's a case to argue for this to be a wave 4 still in the S&P 500, if you look at the idea that this is a wave 4 in the NASDAQ and in mid caps and small caps, it becomes a bit more challenging as we have a fairly disproportional time and price relationship between those two corrections. The alternate we had at our disposal to offer context in the event Plan A did not go our way. But interestingly enough, the structural requirements, so the minimum requirements to suggest a corrective completion, is actually in. We have 5 down, 3 back into the late March highs, and then another 5-wave move to the downside. Could this be an instance where typically it's buy the rumor, sell the news? Could this be a sell the rumor, buy the news situation, with markets seeing how aggressive the Fed is going to be? We also have employment data this week, ADP tomorrow, non-farm payroll on Friday. Before we get to the charts, and thank you guys for tuning in. Hope everything is well. Just got a couple of direct messages. Looks like you guys are okay. One audio issue, but we're good. Before we get to the charts, let's go ahead and bring in the trading analysis team. Good morning, Terry. Good morning, Alex. How are you guys doing today?
Good morning, Bennett. Good morning, guys.
Howdy, howdy.
Hey, good morning.
It's raining in Texas.
If we were going to do this tomorrow, I was all set to say, may the 4th be with you.
I love it.
But we're doing it on the 3rd, so darn it. Tomorrow's Star Wars Day.
Yeah.
Anybody didn't catch that.
Half of my mouth would have been numb, so I don't think it would have gone very well.
Oh, yeah, we couldn't have it. Yeah, Bennett wouldn't be able to talk. So
wouldn't have been fun. Wouldn't have been fun. So what's up, Alex? How are you today, sir?
Yeah, I'm fine. Also waiting for tomorrow's day eagerly to see what will be the narrative. So yeah.
Yep, it's been a tricky year. It's been a tricky year. We're going to get to Optima in just a few minutes. We'll take a look at the rotations. We will, of course, have Alex in to take a look at the macro scene. We've had a huge move up in the dollar. We'll talk about that. We'll also take a look at the current situation in gold as well as crude oil. Before we do that, gentlemen, I'm going to take them through the indexes really quick, and I will be back on the other side. Sounds good? All right. Good. Catch you guys in a couple of minutes.
Yeah.
All right, appreciate you guys all tuning in once again. So let's hit it. Hard right edge of the Motive Wave platform. We're going to go full screen looking at price action in the S&P 500. So first of all, I've got to take you once again back to the COVID low from March of 2020, where we see markets completing, in our opinion, a cycle degree 4th wave flat. What I love about this flat is it's really established itself, at least the wave 4 established itself all the way back in December of 2018. And originally we had this mapped out as a triangle, expecting the move down in a C wave position. But prior to COVID, we were expecting that to maintain north of the 2018 low. But following the COVID low in March of 2020, I continue to view, even with the a bit of a subjective wave count coming out of the lows, given the mixed sentiment and overlapping corrections, I continue to view this structure as simply two actionary waves. We have a big 5-wave rally, which takes us into September of 2020. Notice this green trend channel. This is an Elliott Wave specific channeling technique that uses the low of wave 2 and the low of wave 4. Once those lows are in, you establish a parallel trend line over the top of wave 3, not the peak of wave 3, but the completion of wave 3. Maybe 5 of 3 was a truncation. And that often, when used in combination with upside wave 5 fib projections, will give you more or less zones of resistance that could shut down the rally or the 5-wave impulsive structure. So essentially what happened is we have a big 5-wave move up into that channel resistance. Upon meeting resistance into the cycle degree trend channel, we proceed to consolidate in what I view as a sideways flat in the S&P, a sideways flat finishing late October of 20. From there, we've got a nice 5-wave move up. I'll never forget the first positive coronavirus vaccine news, November 9th of 2020. Nice little gap up on that session. 5 waves up and another 3-wave pullback, this time March of 21. Okay. From there, we can count 5 smaller waves in blue wave 3. And zooming in on this trend, we have a directional zigzag correction. Slight alternation to the characteristics of the correction in that this B wave was about 1.5–2% shy of being considered potentially a flat. It had a very significant B wave retracement. So there is some alternation here between blue 4 and blue 2. Blue 4, however, one of the key guidelines of Elliott suggests the guideline of equality. And you'll notice the correction here was exactly equal to the wave 2 back in March of 21. From there, we have a big 5-wave move up into January of this year. And that's where I view the second actionary wave as having come to completion. What this tells me as an Elliottian is if this is not a wave 4 pairing up to the wave 2 flat, then we're falling victim to the alternate structure, which would suggest the 2 actionary waves separated by one corrective wave. And let me see if I can boost that, Terry. The 2 actionary waves separated by one corrective wave is, and let me try it on this end, Terry. This should help a little bit. Would in fact be a 3-wave structure to make wave 1 of higher degree wave 5 ending diagonal, because we know 3 waves doesn't complete a motive structure. So with price action now trading south of February and March support, it's likely the S&P is on its way back to test 4,000. I am not of the bear case that would suggest the cycle degree wave 5 from the COVID or the credit crisis low has completed. I just don't see the evidence to suggest that's the case. So we have always operated with this as our alternate, and we've been presenting this alternate to you for quite some time. So now let's get off of the daily. We'll focus in on price action in the yellow circle. And what I'm going to do is I'm going to take you first over here. So here we can see going back to January 4th, and this is into yesterday's low. So you can see the initial, what can be counted as a 5-wave structure to the downside, completing February 24th. We have then a big 3-wave retracement. The 3-wave retracement takes us between the 618 and 786, finishing late March. And now we have down in 1, up in 2, down in 3, up in 4, and down in 5. So technically speaking, there is a 535 structure here. Does that mean the low is in? Absolutely not. And this is why over at Trading Analysis with our clients, we're focused on the shorter term, the 10 and the 15-minute chart, looking to identify swings within these subdivisions, because the overall pattern has been a bit murky and we've been in a season of uncertainty. So coming off of this low is really where this market's going to confirm that possibly that was all of the correction, which I don't think is the case. Markets look like they want to test 4,000, fill that micro gap. If you'll recall, we've been highlighting a micro gap in the chart of the S&P, which occurred back here in April of 21 at 40.20. That gap has never been filled. This would be a perfect opportunity to do so. So with 5 down, 3 up, and 5 down in the S&P, we need to be watching price action off the low. If in fact this is not a completed 5-wave structure, chances are this is 1-2-1-2, or this is still 3-4, but we're going to see an extended 5th wave that takes us down to 39.54. Now I'm going to take you down to the 20-minute chart. Looking at the 20-minute chart here, and I first need to draw a retracement of this move. So looking at the 20-minute time frame, and allow me to add an external retracement onto this fib. Going back to late March with the first 5-wave decline, and this was kind of a murky decline as well. There were a couple of possibilities, but it ultimately proved to be a leading diagonal. 3 waves back, and then the big move down in 3. So although the pattern has been a bit murky, we have been able to identify some fairly key swing and decision points with our clients. For instance, going back to last Wednesday when we unfortunately were unable to host the live stream. Last Wednesday we were expecting the 1272 of this little upside 3-wave rally to hold, to stage a 5-wave move up into 4,300. We got that move, and now we've got this big 5-wave down. Yesterday with our clients, we were looking at orange wave 4 resistance to hold at the 38% and expecting a new low. Now that we've got the low, we need to be watching price action very carefully from yesterday's extreme, yesterday's low in the markets, in that the retracement of this will be very telling. If we move impulsively out of this zone, perhaps this is the end of the correction. Alternatively, and which is more likely in my opinion, we move in a corrective manner from the low, and we end up seeing another instance of 1-2. Or, as I mentioned, this is 1-2, this is 3-4, and this is just an extended 5th wave. So at this point, short of market staging an impulsive reversal from yesterday's low, I think it's likely we are moving into the alternate diagonal count. The alternate diagonal count still maintains the higher degree of trend. It just allows for a more significant retracement of the post-COVID low rally. And downside targets here, 39.54, obviously that micro gap fill. You could push all the way down. You could make a case, depending on how the Fed moves and how inflation progresses. You could argue a case that we go all the way back down to 3,600 and retest resistance from September of 2020. Even if this is the case, we remain bullish in the higher degree of trend. So that's the S&P 500. Key levels, as mentioned, on the downside near 4,000. You need to be watching price action in the structure off the low very carefully. Here in the NASDAQ 100, as mentioned, it's a bit difficult to suggest that we are still in a wave 4 pairing up to this as our wave 2. With that being the case, and this is one of the reasons, while it's possible in the S&P, it's probably not likely. With this being the case, we're operating under the exact same wave count, which suggests from the March low in 2020, we have a first actionary wave, a corrective wave, up in 1, down in 2, up in 3, triangle 4, ending diagonal in 5. That explains kind of the unusual price action. And now we have down in A, up in B, and we're working 1, 2. Same structure from the B wave. We have technically 5 waves, likely not a completion. Watch the price action from the low. And then over to the Russell 2000. Here in the Russell 2000, this is one index that really illustrates well the idea that while it's technically still possible to suggest this as a 4th wave, it's becoming less and less likely given the disproportional time and price relationship. Initially, there was a lot going for this correction. It had equality met into the low in February. The 38.2% retracement of the wave 3 rally was acting as support. We're now seeing further downside there, which is, again, likely a product of the alternate, which says we had a big 5-wave move down, 3 waves back, and we're going to meander in 5 waves to complete the C wave decline. So that's it for me. I don't want to take too much time. We'll go ahead and leave it at that. We'll jump back over to the trading analysis team. What do you guys think? Ending diagonal is upon us?
Bennett.
Likely the ending diagonal. Any votes, Alex, Terry?
I wouldn't vote for any of it, but it's just been a practice of patience. I think we knew that the market was going to continue to push lower, but you know, there are several different there's several different ways it can continue to play out, as you just pointed out, to the downside, but it's doing so in a very methodical and slow manner. So, and that's what I'm going to cover here in my part in just a minute.
Yeah, we haven't even seen
what happened here in April.
If you take a look at the VIX, you know, you haven't seen what you would expect in such a market that we've been in. So, all right, we're going to go ahead and leave it there. We're going to jump into sector focus with Terry and Optima. Got the screen share ready. Are you ready to go, sir?
Oh, sure. Yes, sir.
He's always ready. All right, take it away, Terry. We'll be back on the other side.
Hello, traders. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. Now, as you probably know by now, the April market saw the largest monthly declines that we've seen since autumn of 2008. The S&P fell 9.1% in April, and the NDX was down 13.5%. So 4 weeks in a row of negativity, some volatility in the middle of the month here, and then just a major push lower, and then ending the month last Friday with a huge push down. So Monday's relief was where a Monday's bounce, I would say, was definitely a bit of a relief in the market. And if you were watching intraday trading on Monday, that last hour of trading right here snapped the market back up. So yesterday we actually have achieved a positive 0.57% gain for the S&P and a whopping 1.72% gain here in the NDX. So again, some big down days. This is last week's sector performance, and as you can see here, all 11 sectors were in the red this past week. The consumer discretionary sector was the week's worst performer, down 7.36%. But utilities, financials, and real estate sectors also were each down more than 4%. Now, the best performing sectors were materials, technology, and energy sectors, declining only 0.8 to about 1.38%. Let me move this out of the way and let's take a look at this. Is just, of course, we do this on Wednesday. We have 2 days worth of price action here in the indexes and the sectors to show you, but this is just Monday's price action here. And I have a table over here. We'll go ahead and pull that little table out. That pulls in some live pre-market data, I know. But we have the communication sector here out in the lead, up 2.98%. Technology, 1.87%. And the consumer discretionary, 1.46%. So what's the common theme between these three sectors here? Yes, those are our primary growth sectors, and all the rest of these are our value sectors. To the downside, we're seeing a big pullback here in the real estate sector, and staples, utilities, healthcare, and materials all trending lower this week. If we move over here into our relative strength sector leader scoreboard, the energy sector has somehow managed to retain its abnormally high relative strength, even though it's been going on 8 weeks now. Let's pull this thing back and show you. Let's go back. There's 8 weeks. We got 8 weeks of just a vertical decline where we have lost all the momentum in the energy sector. Essentially, the momentum is neutral. Okay, back here close to 100, it's equivalent to the S&P. So the momentum is neutral, but the relative strength remains very high. Now, over here, utilities, healthcare, real estate, materials, staples, industrials, they technically still remain here in the leading quadrant, and they are outperforming the benchmark S&P to varying degrees. But during this same period, we've seen the financial sector separate from this pack. The financial sector was part of this pack earlier in March, late March, and coming into April. And then we saw the financial sector rapidly decline, push down. Now the financial sector we see is here in the lagging quadrant, joining the technology and consumer discretionary. And the difference now being the vector is pointing to the southwest, which means the financial group is continuing to lose relative strength and continuing to lose momentum, while we are seeing some positive momentum moving higher here back in technology and discretionary. Now, major disappointments in the streaming services guidance might now be offset by some renewed optimism in Facebook last week as they reported favorable earnings and forward guidance. And the communications sector is once again showing a northeasterly vector. It's looking to potentially begin a advance into the improving quadrant. So I'm not going to go through much more detail in any of the rest of this stuff. We'll save that for our subscribers today, but we do see energy making a bit of a corrective bounce here. I think there's still another push lower in energy before later on we'll see that relative strength really pay out and there'll be another rally there. We've also been monitoring the gold, and as gold is coming down into this bottoming area, this support area, we've actually started to take on some speculative long positions with our clients in the gold miners, and possibly we see this base forming right here and we get our signal that we've got a turnaround. We're going to have some more plays for you guys. That's all I've got, Bennett. I'll hand it back to you.
Much appreciated. Thank you so much, Terry. Yeah, speaking of gold, we shorted the B wave high in that wave two, took advantage of the B wave resistance there, and we're still aware of the idea that that move to 2078 could have been a corrective rally. If that's the case, we'll fall back into the downside, but we definitely couldn't help but nibble on the fib support zone that was responding accordingly. Could be an upside impulse. We're gonna let that one play out. So excellent work, sir. Alex, you ready to go, boss?
Yeah, sure. Let's roll it.
All right. Let's hit it, and then we'll be back on the other side. Markets are open in about 3 minutes. Here we go.
Hey guys, let's look a little bit of macro scene as usual on the stream. This day, of course, 1 day earlier than usual, but it doesn't change much of a picture. Tomorrow is a Fed meeting. Sorry. So CPI is moving higher, as you know, in the States and in Europe. Most of these CPI prices, as you probably know, consist of the elevated energy prices. So if we look the US 10-year yields, as I said the last week, this is a longer-term chart on the log scale. We have a relatively substantial reading on the RSI, which has not been seen almost from 1981. If you look all of the previous highs, of course, we were in deflationary falling rate environment. And currently, I do see a potential, just maybe a couple of months or two reversal. This is the previous resistance zones. We are touching 2.9. I think we're going to go up to 3.1, and then just a reverse for a period of time, because what I see on some other charts in commodity spectrum, they also suggest a bit of a pause, which can actually stream into the figures in the next couple of months. So we might see a smaller pullback after this potential resistance zone hold. If we start breaking this up higher, above 3.2, 3.3, 3.5%, then the things will be really exuberant on the upside with targets around 5%. I don't think there is an environment currently that to happen. So I think Fed's narrative, it's going to be especially focused on how they're going to roll off their balance sheet, and of course how they see these inflationary pressures, which are going to stay with us just because of energy prices. And I'm going to show you a couple of charts in the energy spectrum, which clearly points out that the energy prices will be elevated at least for next couple of months. So if we go into Europe, which is in much more difficult situation, so the ECB, I think it's going to be on Thursday. The government 10-year bonds, this is the yield chart. I was also showing you regularly the price chart, but the yield chart is moving on the upside. We are trading, as you can see, close to 1%, so 0.922. We still don't have a clear 5-wave move, so I would like to have a clarity on a confirmation for the ABC pullback here in this deflationary secular trend. As you can see from 1980s, we are moving lower. So potentially we have a cyclical year or two, inflationary pressure. And of course, energy prices, as you know, are greatly involved with the European Union, less in the United States because it's energy sufficient. And as you're going to see, the prices of the energy is rising, and also inflation is rising in Europe. So I think the ECB will have to move with rates on the upside, but they will do it much more gradually and much more on a slower manner than in US because of the situation of the debt peripherals in the European Union, and also many other problems which Europe will face in regards of the energy crisis from Russia-Ukraine war. So we have to, of course, look what the dollar is doing. Dollar is moving on the upside. We have reached one of the previous highs in 2000, I think justly. Let me just check this, but I think we traded from the 2017 a little bit around 103, which was 103.77, which was the high even from 2017. So this looks pretty impulsive, so this will continue on the upside at least for some time. I'm looking from 108 to 110 target, so a little bit prolonged dollar fifth wave on the upside. We were looking for a reversal here at 0.786. It didn't hold, and of course the war broke out, which managed to push dollar moving higher. And as you can see, RSI reading is around 80. So this is still not done looking the wave count. So I do expect just a little bit of pullback in a fourth wave, and then a continuation towards 106, 110. And if we get something even more exuberant, even higher, so we'll need to track that. But I don't think this rally is over. I think we will see a couple of legs more on the upside on the dollar index. As the oil is concerned, I'm looking the longer term chart of Brent. I've been relatively not so fast to pronounce the end of this rally of the oil on the upside. As you can see, the previous technically the previous resistance zones are in this range from 93 to 110, even 120. As you remember, a couple of months before the war, I was looking from 1937. From these levels, we reached almost 1940 due to war, and currently we're just consolidated. Until we break this range below 95, 91, I'm going to stay with the outlook that oil might even break out higher, because this looks like a small triangle forming. And if this starts keep consolidating on the sideway, usually you're going to see the breakout on the upside in the direction of the trend. So oil is still kind of consolidating here. We will see, I think, a little bit more consolidation before we break on the upside, with the condition the price kind of stays above this support zone, which comes from 96 to 91 on the downside. So as you can see, just a small consolidation. So if we switch to Thomson Reuters Commodity Index, which I've shown a couple of times, the uptrend still existing. So this is pretty much 5 waves almost over. That's why I look a little bit of pause, because this Thomson CRB index was greatly in line with the 10-year yields. If you overlay these two, which I think I already also showed you, you will get a relatively nice correlation with these two. As you can see, that was not the case so much in the past, but from the COVID lows, as you can see, these two are going pretty much nicely together. So I do think, looking just technically, that this 5-wave move will be completed soon in the next couple of weeks. We're going to see a little bit of a relief, at least temporary, in the commodity prices and on the yields lower, as I said. So going further on the net gas prices, and that's why I said I think the energy prices will be elevated in much of 2022 from the lows. Net gas still didn't trace out the complete 5-wave move on the upside. We are seeing a leading diagonal here in a wave 1, down in 2, and then a nice separation between the lesser degree 5-wave move on the upside, which is still ongoing. I think we're going to hit around 10. This is the Henry Hub futures. So I think we get a go for a $2 more on the upside. Then we're going to have a small correction in some type either of a triangle or a complex in a 4th wave, and then after, until the end of 2023, even beginning of 2020, 2022, beginning of 2023, we might see a continuation on the upside in the net gas prices. One of the targets, it's around between 13 and 15 on the upside, because the previous high, if you see the chart, it's usually kind of a nice resistance levels. I'm going to draw a couple of fib ratios on the upside, which we usually look for the potential end of the 5th wave when we have the 4th wave unfolding. But for now, as you can see, the net gas prices are still moving higher. Even if you look this lesser degree development on the upside, you can see that we still didn't actually fulfill a 5-wave sequence in this 5th wave. We have a wave 1 and 2 up in 3. So we will see maybe a small consolidation in wave 4 and the move further up to 10, even 11 on the net gas prices very soon. So a chart of the gold and silver, which we looked pretty much many times in the past. So this is the gold chart, which I've looked many times with you guys. We came to the point, or to the decision point. As you can see, the RSI on daily is pretty lower. And if you look, this is just an ABC pullback. We need to see a 5-wave move on the upside and a reversal on gold to look for the higher prices. If we see a break of these lower levels, that definitely something else is going on gold. So we have been looking for this reversal, which actually was not pretty complicated. It's just a simple ABC movement, and we are very close to 786 and equality measured move. And there you will see, if we see a bounce in 5 waves and a small pullback, that will be a sign that a new movement on the upside has started. Silver is moving lower as we were looking for a sharp reversal on silver. We have been flagging this. I've been not so surprised for this reversal, only 3 waves on the upside. a little bit of confluence in this I would say a channel resistance upside lines, but we couldn't break it on the upside to actually have a 5-way move on the upside, and then we are seeing a nice reversal on the downside. I think we're gonna hit lower levels. This is a 400 days almost of a consolidation in silver. 200 moving average on weekly comes around a little bit above 19.5, 20. And there is some fib ratios clustered there. So silver is moving lower, and I think either we're going to see some larger consolidation in triangle and then move lower, or directional move lower, but I think we're going to finish below this line a little bit between 18 and 19 on silver before we see potentially some type of a reversal on the upside. So yeah, so tomorrow, look, of course, the press conference, Jerome Powell will have many things to say in regards of the Fed's outlook on inflation, a rollover of the balance sheet, and how they will proceed with that. So I think it's going to be a pretty important day. So see you next week, guys. Back to you, Ben.
Thank you so much, Alex. Excellent work as always. Inflation is no longer transitory. I think it went from 3 months to 6 months to runaway. I don't know. It's been a fun ride, but yeah, good stuff. Good stuff. Not tomorrow morning, but typically it's tomorrow morning because we're here Wednesdays. But Thursday morning, you got Crypto Lab, Alex?
Yeah, tomorrow the Crypto Lab is running as usual, 3 p.m. my time. So.
Yep. So Thursday, 9 a.m. Eastern. Right here on the Trading Analysis YouTube channel. Team, excellent work. Members, we'll see you in about 19, 20 minutes for the member webinar. And viewers, traders, investors, we'll see you guys next week. Check us out, tradinganalysis.com. We would encourage you to test drive our services, see what we have to offer, and we'll leave it at that. Terry, Alex, good work, gentlemen.
Thanks for joining us today, guys. Bye.
All right, take it easy. Take care.